You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Her websites, JugglingDynamite.com and VenablePark.com. Welcome back to the show.
Thank you, Jim.
The latest employment data from both the U.S. and Canadian governments seems positive, with unemployment going down, job numbers going up. But are they so sketchy and so many estimates are involved that they're not that reliable?
Well, it's a complicated calculation, but the increasing population has been a major factor because the rate of change has been much higher than in previous years. And so that's really throwing a wrench into things. It's difficult for all those moving parts to get tabulated accurately within a few weeks of the end of a month, that sort of thing, and yet we report these things every month. But for example, in the U.S., the work week is part of the leading economic indicators, while the NFP payroll estimate with the birth-death model, all that stuff is part of the coincident indicators of the economy. So when you see, for example, that the employment survey response rate, another factor here, to the NFP stuff is only at 43%. So they do this survey of companies, and only 43% of them are answering the survey. And before COVID, that was more than 60%. So again, you're getting a smaller sample size, but also, the headline number of what the actual unemployment rate is, that's heavily subject to revision many months and sometimes years after the fact. So that's a tricky bit of business to do any sort of allocation decisions or, take as gospel. But the U.S. work week, as I say, part of the leading economic indicators, the one that gives you the best heads up, is actually a negative 0.3% over the last year and has fallen to 34 hours. So 34.2 hours worked is actually the weakest level for that metric since April of 2020, and it's the same level as we've seen heading into the last three recessions. Private sector employment is negative 0.4 year over year. That's only happened before recessions in the last 80 years or so. The business sector employs 75% of the workforce, but we know that governments have been creating the lion's share of any jobs in the last couple of years. So, in Canada, the labor force participation rate, the unemployment rate ticked down 1 point, but the participation rate fell to less than 65% of the population. That's actually the lowest since 2021. So as I say, if you can focus on these things that are sort of more the leading stuff that is less guesstimated, you sort of get a lay of the land. The other thing is, as I mentioned, the median increase in the unemployment rate 12 months after the Fed's first rate cut is about 2%, Jim. A 2% increase. So this, currently you've got a consensus view that the unemployment rate is going to basically tick up a tiny amount and then stay flat. And that was Jay Powell's, assertion at the last FOMC press conference was, we think it's going to hold in about here. Well, there's never been such a thing as the unemployment rate holding in as the Fed hikes interest rates. So it's always increased, as they say, by a median of a couple of percent. So, that would be like 6.2% if it did that this time from the 4.2 presently. And that's a big change, again, starting from a really low level of unemployment is any increase of 1% or 2% is proportionally much greater than if you were starting from a higher rate of unemployment and you went up 1% or 2%. The same thing kind of that we saw with the interest rate phenomenon. Again, when they started hiking rates from off of the all-time lows, Jim, from the pandemic when the policy rates were 0 to 0.25 to 25 basis points, people say, oh, well, they're only at 2% as an overnight rate, or 3% or 4%. Oh, they're only at 5%. Yeah, but it's not about that. It's about the rate of change because they came off zero, so that massive impact is such a huge shock to the system. So I think the law of low numbers has thrown a lot of people off understanding the actual impact of this stuff. I mean, just 50% of Canadians looking for work in the last year have actually found work. That was about 84% in the year before that. So, small businesses, as I've mentioned before, create the lion's share of employment in the economy, notwithstanding the fact that governments have been ramping it up so that they're spending, a huge amount of GDP in the last couple of years has come from this deficit spending from governments, which, it's hard to imagine it can continue. The overall level of government debt globally is now about 100% of the global GDP. It's never been that high. And in countries like America, they've been spending about 6% of GDP in deficit, which is something, unprecedented before. Typically in past recessions, you'd see the U.S. government run a deficit of something like 3 or 4% of GDP. So here we are, supposedly in a boom, right? Supposedly no recession in sight. If you believe the consensus view, is that, there's only blue skies coming here, and something like 8% of people surveyed expect a recession now. It's down from, it was higher a couple of years ago, but now they've decided they've been banned or, obliterated by devoted central banks, and governments just won't let it happen and all that kind of narrative. So you've got this huge preponderance of investors. 76% of those surveyed recently said they expect a soft landing, so no contraction in the economy, no increase in the unemployment rate, notwithstanding that you don't even need a recession to get an increase in the unemployment rate so long as the central banks are cutting interest rates. Again, that's counterintuitive. People think, oh, great, they're cutting rates, all is solved. But it takes this, multi-quarter time for that to really filter through. And even, recently, Royal Bank was writing about, the fact that we've talked about this before, how many Canadians have mortgages coming up for renewal. And again, people say, well, relatively rates are only around 5% for mortgages and 4% if you're talking about shorter terms. And, that's relatively low. It is. But the thing is, during the pandemic, again, most people took out mortgages that were under 3%, some under 2%, floating rate mortgages under 2%. So when you get something coming up for renewal at 4 and 5%, that's a lot more in terms of servicing costs. So we're seeing a retrenchment in consumers and pulling back. But Royal Bank's report was just pointing out that it's likely to be the increase in the unemployment rate that presents even greater challenge. So there's the funding cost increase, but the Bank of Canada is expected to, they've already come off 75 basis points in the overnight funding rate. They're expected to slash another probably 100 basis points by the end of 2024. But by the Bank of Canada's estimate, the neutral rate, the rate where you're not constricting the economy or stimulating the economy, is probably about 2.75. Well, of course, as I say, they're well above that. And so when you look at that and you realize that the unemployment rate is likely to rise for the next year and beyond, then you start to be concerned about how Canadians with the highest debt-to-income ratios in most of the developed world are going to fare in a time when, sure, interest rate costs are going up, but more importantly, they're going to be losing their jobs. A lot of people looking for second and third jobs. The unemployment claims have been slow to pick up this time. I think a lot of that has to do with the crushing overhead that so many people have now, especially, with housing obscenely but priced, and many of them bought or levered when rates were low, and so now they're dealing with the carrying costs of all that. Bought vehicles when they were really inflated during the pandemic, and they had to finance that, so they've got so much debt. Canadian household debt is about 175% of disposable income. At least it was in the second quarter of 24. So that's come off the high, Jim. It was at the all-time high. Canadians are kind of focused on paying down their debt now because they really feel the stress and strain of having too much of that. But the household debt-to-income ratio in the fourth quarter of 2008, as we were heading into that downturn, was only about 156% in Canada, and we still saw a lot of stress and strife. And when people got laid off, a lot of debt debt defaults and delinquencies falling behind. We've already seen, as we've talked before, about a massive jump in the filing of bankruptcies, consumers' proposals for households as well as businesses, and that's happening in America and Canada. So all of that is happening, as I say, with the unemployment rate still relatively low, but this deterioration in hours worked and income overall. And then you've got, the gig economy. So when people are feeling the strife of higher payments and or they're losing, wages in terms of their main job, or maybe they've lost their job altogether, they're more inclined to try and, drive Uber or deliver food or do something on the in terms of the gig economy that might replace more of their income than just taking, an unemployment check, which, restricts, you're not allowed to work more than so many hours if you're collecting that, and it tends to be a fraction of what you were earning while you were working. So the more overhead people have, the less flexibility they have, the more they're going to try and figure out other ways to earn income before they resort, finally to unemployment claims. Although eventually that seems to be, what they're doing. Certainly in Canada, they're starting to tick up as well.
We'll have more with Danielle Park right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, does easing money, making money cheaper, does that solve problems or does it just create more?
Yeah, well, I think we've learned this now in real time. This was an experiment, right? They were saying, because we'd never seen rates at zero, certainly not in our lifetime and not in modern history. This idea that making credit cheap and freely available helps people in the longer run has just been proven to be false. If that was true, low rates would have enabled everyone to get out of debt and build up their savings, right? But in fact, it did the exact opposite. Now, a very interesting little tidbit there, though, is, of course, everyone's been talking about the strain on households and debtors because rates increased back towards more long-term norms. But in fact, what's been discounted or not mentioned is the fact that there's been this big increase in the amount of income that people are earning on their savings, and that has actually been positive for savers. And but the problem is, of course, as I said, coming into this, the bulk of the economy was highly indebted, and so what they're losing because of the carrying costs and their inability to consume and spend on other things is really hitting the overall economy, because the Canadian economy is about 56% dependent on household spending, more than 70% in the U.S. You look at a country like China, and their household spending is more like 30%, 35% of their GDP. And so here you go. This is really pushing on a string, right? So the Chinese economy, as we know, is kind of going through this mirror image of what happened in Japan in the late 80s, where they had these big, they had a big stock market bubble, then they had a big housing real estate bubble, then both burst consecutively. And then a whole bunch of debt was left and no assets to sufficiently, they couldn't sell assets enough to pay off all the debt, and so banks were sitting with all these uncollectible debts, and there was all this kind of creative accounting to try and cover all this up. Well, that went on for years in Japan, of course, and it took many decades for asset prices to recover. Well, the same thing has been kind of going on in China, right, where their stock market burst in 2007-8, and that cycle it got so extremely overvalued, and then prices collapsed. And then we've seen a couple of runs where households have gone back to trying to get rich quick, so to speak, in asset speculation, but they ultimately came to real estate as the primary one. And that's where all the government incentives, just like in Canada, really, the government really heavily incentivized people to borrow and buy real estate, right, by giving them cheap down payments, by backstopping it through the CMHC, by the central bank, supporting liquidity in the banking system and trying to get banks banks to loan lots. And so there was this whole wave of money going into real estate. And as you know, that didn't do us any favors because the price of real estate just basically doubled over a period of 5 years. And so that's part and parcel of why the households became so heavily indebted, just trying to keep a roof over their head. So we've seen this balance sheet recession theme, which Richard Koo talks about, and you can find great interviews of his on the internet. But basically, he's an economist who was in the Japanese debacle and saw it firsthand, and then has been warning this is what China was doing as well, in funneling and incentivizing all this speculation in the housing market after the stock market bubbles kept hurting people. So 80% of household wealth in China was basically in real estate. And real estate prices have fallen 33% from the peak about 4 years ago. So that's really leaving a mark, as you can imagine. And so now the government's really trying to, meanwhile, bond prices in China continue to rally through this slowing growth environment, treasury bond prices, so yields have come down. So it's not a constraint about borrowing costs, but the government just keeps trying to, make it more cheap for people to borrow and speculate in assets, because they're trying to sop up all this excess supply that got built because rates were so low for so long. So again, a lot of malallocation, a lot of building the wrong kinds of properties in the wrong spots, a lot of overpaying, and real estate development companies making off like bandits for a while, and then suddenly they go bust. We saw that in the last 4 years in China. Some of the largest real estate developers in the world have gone bust, and we're seeing that in North America now, where a lot of developers are coming under stress because they're having a collapse in the appetite or ability of people to take on more debt to buy more of these properties. So the whole point of this is that the central banks and governments end up pushing on a string once households get so indebted, and they become fixated then on not how do I borrow and speculate more, but how do I get rid of this debt? How do I get savings built up? They feel it in their bones that they're very vulnerable, and they want to build up their own their own strength. And so we're seeing that in the Chinese economy. So the growth rate has really fallen there significantly to about half or less than half of what it was at the peak of the expansionary phase. And, you're getting a lot of disgruntledness among the population. And so the Chinese government keeps going back to, okay, well, let's try this, let's try that. But ultimately, there's a huge incentive for households and businesses to try and save and not speculate anymore. So the same kind of thing is happening, in Canada, where a massive amount of household wealth, about 55% of net worth in Canada, household net worth, the average, is in the real estate market. Well, in some places like in Toronto, we've seen sort of like China where they've got prices off about 33% from the peak. In some parts of the GTA, there's, prices have come off 30 and 40% already. And this is all kind of below the surface because nationally when people quote these national figures, they say, real estate's off maybe 14% from the peak of 2022, but it's holding in there, it's not doing too bad. But, when the bulk of the net worth of the country, of the households, starts to decline because asset prices are falling, and we're seeing this now in America as well in major centers that got overdone during the hype of the low-rate era. And, of course, now we've got catastrophic weather events wiping people out. Insurance is harder and harder to get or extremely more expensive. So this is all weighing against this interest or appetite for being really long a lot of real estate exposure. And I think this is a multi-year cycle typically where prices contract and continue to fall and people look to sell and delever. And, I think we're pretty early on in this in terms of Canada. And it's going to continue in China as well by all accounts. And frankly, the older people are, the older the population, the less they want to have all the stress and strain of carrying costs, and the more they want to seek movement towards being mortgage-free and that sort of thing. So I think all of that together is going to continue to be a headwind for, stimulative ideas about adding more credit and stirring. And that seems to be the main playbook, whether it's the Biden administration, whether it's the Republicans or Democrats, whether it's Trump gets in or Harris, it's all sort of the same idea of how do we borrow and spend, how do we try and prod more consumption, and I think we're getting to the end of that for a bit.
Now, we live in a time of high financial risk. How do you protect yourself from collapsing along with a stock market that could suddenly overcorrect?
Yeah, so this is another, function, byproduct, gift given to us by many years of easy money and repeated bailouts for some actors in the economy, certainly not all, but financial sector in particular has really gorged at the buffet of government handouts, and frankly not being prosecuted sufficiently for crimes. We see the TD fiasco recently for all the money laundering, and they're getting dinged with several $1 billion in fee and fines, and that's really sort of a bit of a sobering heads up to, a sector that's been really lawless for a long time and making profits and all that. But again, these things tend to run in waves. And so, I think anytime you get the euphoria in the public, I was explaining this to some young people on the weekend who are asking me about, how do they get ahead and why are some people, seemingly speculating so successfully, et cetera. And it really is a function, I think, of, first of all, again, when rates are at zero, when people learn the behavior of gambling as a main approach, when the financial sector recommends gambling because they collect the most fees and commissions and transaction revenues off of people gambling, then you get this whole kind of bias of the system towards that. And so, passive fund flows or passive investing vehicles now hold about 60% of the S&P 500 market cap. So that just gives you an example of very few people are doing math anymore. They're just like taking whatever flows they have and throwing it in, and they're using the fact that prices went up as justification that they were correct or smart or savvy and this sort of thing. But the reality is that the equity risk premium right now, because prices are ridiculously high, like just as one measure, the stock market as a ratio of the GDP of America right now is 209 times, or 209% GDP. Well, that historically, it's the highest we've seen in many decades. And every time you get that far, which is essentially more than 2 standard deviations above the long-term norm, you get a major correction phase where prices fall and go way below the mean. So right now we've also got, as I say, the oldest population because of all the boomers, and they're the bulk of the asset owners. And so when you see that kind of thing, right now in terms of allocations to the stock market, we've got the highest allocations to the stock market that we've seen in many, many years. Most people are blindly holding. They haven't rebalanced. They've been on this run for the past couple of years as things have gone from, they were starting to sell off and then they've rebounded again. So people got from that, buy the dip, don't worry about anything going down, it'll only go up. Well, 20% of Canadians are now over the age of 65, about 18% in the U.S., and they own the bulk of the assets, certainly of the stock market. And so right now they're dealing with extreme valuations of just paying way too much for something. The stock market, the S&P's gone up about 30% in the last year, but the earnings per share expectation for the fourth quarter are unchanged since July of 2023. So this is pure animal spirits, Jim. So what I would suggest to people is that they, I know there's lots of people who say, oh, you're too worried, you've been too negative, and I'm like, listen, I'm just doing the actual measurements. How many measurements are you taking when you're gambling with your life savings and throwing it all in? What actual work have you done to check what kind of risk you're taking on? As I say, the relative to the safe rates or the cash deposit rates or high interest savings rates, which are the highest that we've, even though they've come off, they're still pretty much the highest since 2007. Relative to that, the stock market is so overpriced that it is offering like a 0.5% of expected return potential over the next decade relative to the risk-free rate. So there is no compensation or reward for taking on that kind of risk. And so what people really need to do is take a sober assessment, get a second opinion. Don't just keep going to the sales force who constantly tell people that they should buy risk and hold it. That's their whole business model. And they will say the same thing to them when everything starts crashing, they'll tell them not to panic, and then what most people do is they sell at the bottom. So that's just the way humans react. That's, we're not pensions. If we were, pensions have a longer risk tolerance and window because no individual can call them up and go, sell all my stuff, it's falling, I want out. But that's what humans do. And so a lot of people are, managing their own retirement savings, or they've got a broker or a manager who they can call when things drop and say, this is it, I want out, you're fired, whatever. And that is, in fact, what they do. So what you need to think about is, if you're approaching retirement or in retirement, you should not have very much of your money in the stock market at all. Arguably, at these levels, you should have next to nothing if you're worried about the risk, because it is so obscenely priced. And yes, it can continue longer, and it has continued longer, but there's never been a time in history when it didn't mean revert ultimately, which means at some point here, the opportunities on offer are going to become like they were briefly in 2009, like they were very briefly and not as well in 2020, but the point is, we haven't seen things this off the charts since the peak of 2000. At that point, prices fell, 50 to 80%, depending on the index, and they took about 15 years to recover. So, how will you feel if you're within a few years or already into retirement if whatever percentage you've got in the stock market falls by a lot and takes years to recover? I would submit that most people will respond badly and jump out of a moving vehicle and hurt themselves. So that is the kind of sober assessment you have to look at when you're talking about your life savings. It's not just, a few bucks in a trading account where you can, whale away, or if you're 20 and you're putting a couple of $100 a month into a balanced fund. I'm not talking about that. I'm talking about the people who are fully invested with the bulk of their life savings today. That is a whole other ballgame.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. Her websites, jugglingdynamite.com and venablepark.com. If you have any questions for Danielle or for any of our guests, you can send them to info@housestreet.com. Find us on X @HouseStreet. Our YouTube channel is Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.